Welcome to the deep dive. Today we're tackling, well, a pretty hefty document, the Yum Brands Q3 2025 earnings report. We're going to boil it down to what you really need to know.
Yeah, and this one's crucial because Yum Brands, one of the biggest players in fast food globally, is making some huge moves. We're talking major strategy shifts, new leaders, and honestly, some really different stories across their big brands.
Absolutely. We're digging into that Q3 2025 call-in report from November 4th, and the big headline, the one that really changes the game, Yum, is looking at strategic options for Pizza Hut. That could even mean selling it off.
It's massive,
Yeah.
selling Pizza Hut. That basically dismantles the big three structure they've had for, well, decades.
Right. So our mission today is to cut through all the corporate speak. We want to pull out the key takeaways for you, understand what this Pizza Hut news really means, look at why KFC and Taco Bell are doing so well, and, figure out how the new leadership and their tech plans fit together.
Exactly. It's a tale of two, maybe three different companies under one umbrella right now.
Okay, before we get into the weeds, let's just set the scene financially. Overall, Yum looks okay on the surface. Worldwide system sales up 5%. Core operating profit grew 7%.
And their diluted EPS, earnings per share, if you exclude special items, was $1.58. That's up 15% year over year, which is, pretty healthy.
Pretty healthy, yes. But like you said, those headline numbers are really being propped up by certain parts of the business.
Totally. The growth is coming almost entirely from KFC and Taco Bell. So while the company overall is performing, it feels a bit like they're considering, well, shedding a limb to run faster. Let's unpack that strategic shift first.
Okay, segment one. New leadership and their priorities. There's been a change at the top. Chris Turner is the new CEO, and Ranjith Roy, who goes by Roy, he's the new CFO.
And Roy isn't exactly an outsider. He spent, 15 years advising Yum when he was at Goldman Sachs, so he knows the business inside out.
What's striking is how fast Turner set out his vision. He didn't just give vague corporate goals. He laid out three really clear priorities. It signals a shift, I think.
Definitely. He put down three specific markers for growth.
Okay, so what are they? Don't all these big QSR companies talk about consumers and franchisees and tech? What's actually different here?
That's fair. Lots of companies say these things, but where Yum seems different is how they're backing it up with actual changes in structure and who they're putting in charge. So the three pillars are:
First one, consumer-first relevance. Basically staying cool and relevant, especially with younger generations.
Right. Number two, franchise economics. Turner specifically called franchisees the lifeblood. So it's about using Yum's huge global scale, not just for corporate benefit, but to really boost the profitability of the individual stores. Because if those stores aren't making good money, the whole system struggles.
Makes sense. And the third one?
Technology extension. This is clearly a huge focus, extending their Byte tech platform across more and more restaurants. They see it as a key differentiator.
Okay, so how are they making these priorities real? You mentioned appointments.
Exactly. This shows it's more than just talk. They took Sean Tresvant, who's been killing it as Taco Bell CEO, and made him Yum Chief Consumer Officer. He's now overseeing Collider 2, their internal consumer insights group.
Wow, pulling the CEO of your star brand into a corporate role. That's a bold move. Shows they're serious about that consumer relevance thing.
It's basically saying, let's take what works at Taco Bell and spread it around. And on the tech side, Jim Dosh got promoted. He's now the Yum Chief Digital Technology Officer and President of Byte by Yum. So big focus there.
And didn't you mention something about scale?
Yes, this ties back to helping the franchisees. They plan to create a new role, Chief Scale Officer, someone whose entire job is figuring out how to use Yum's massive size. We're talking 55,000 restaurants to maximize franchise profits. That directly links back to that second pillar.
Okay, that chief scale officer role sounds genuinely new. Let's move to Taco Bell then, Sean Tresvant's old stomping grounds. Just
on fire, right. Oh, completely unstoppable. Taco Bell is definitely the growth engine. They had, 7% same-store sales growth in the U.S., which is industry-leading, and 6% internationally.
So existing stores are just pulling in way more customers or getting them to spend more.
Both, probably. And that drove 9% system sales growth overall for the brand. It's huge.
And in terms of profit.
It's now 36% of their total divisional operating profit. Just Taco Bell.
So what's the magic formula there?
Well, they always talk about craveable food, convenience, value, but they're also masters of buzz. The collaborations they mentioned, like with Tony Hawk and Bad Birdie. Yeah. That keeps them top of mind with younger crowds.
And drinks too, right? Refrescas, Baja Blast, Midnight.
Exactly. Plus, they nail the value proposition. That $3 grilled steak burrito they highlighted, and keeping lots of items under $2 and $3. that resonates.
But here's the thing that blew my mind. Their U.S. restaurant margins were almost 24%, 23.9% actually, up 50 basis points from last year. How did they do that when beef prices were apparently soaring?
Yeah, they mentioned a double-digit headwind from beef inflation during the quarter. It shows incredible operational control. They manage costs through their scale, smart pricing, but they keep those value items really visible.
And digital must play a role too.
Absolutely. Digital mix hit a record, sales up 28% year over year. Digital orders are typically higher margin, plus you get all that customer data.
Okay, so that incredible momentum leads to something, well, really unexpected. They bought 128 Taco Bell restaurants in the Southeast U.S.
Right. For $670 million cash. This is super unusual for Yum. It kind of goes against their whole asset-light franchise model.
That's the foundation of their business model, isn't it? Letting franchisees handle the capital costs of building and running stores.
Exactly. So this isn't just buying some stores. It feels like a deliberate temporary shift in strategy for that specific market.
They were careful to say the overall asset-light model isn't changing, so why do this? Why spend $670 million owning restaurants?
They called it a strategic investment with outsized strategic benefits and financial returns. They think they can run these stores better, accelerate profit growth, and basically kickstart faster new unit development in that region.
And they put a number on it.
Yeah, they expect these stores to add about $70 million in incremental EBITDA by 2026. That's a pretty solid return they're projecting.
So it's like a targeted intervention, using their own capital to juice growth in a key area. And we should also mention the Live Más Cafe pilot quickly.
Oh, yeah, the beverage-focused concept. 13 open, aiming for 30. Apparently, that pilot is what led to the successful system-wide launch of the Refrescas drinks. So Taco Bell is just innovating constantly.
Okay, let's switch gears to the other giant, KFC.
Yeah.
Still the biggest piece of the pie, right?
By far. KFC brings in 53% of the divisional operating profit. And it's growing strongly, too. 6% unit growth, 3% same-store sales growth. That drove 14% core operating profit growth for KFC.
And they're building stores like crazy.
Record pace. 760 gross new units just in Q3. That's a quarterly record for KFC. They're on track for nearly 3,000 new restaurants globally this year. Another record.
Wow. And the international performance sounds really strong.
Yeah, especially in some developed markets where they've really pushed the brand image upscale. Like the UK, same-store sales up 9%, transaction growth 6%. South Africa saw 7% growth, really connecting with younger people there.
And that Italy anecdote was amazing.
Right. The new franchisee, COB, doubled the number of stores and pushed the average store revenue, the AUV, up to $2 million. And opening a flagship KFC near the Spanish Steps and Trevi Fountain in Rome.
That's not your typical fast food location.
Exactly. It's a statement. It shows they see KFC as a premium global brand way beyond its U.S. perception sometimes.
Okay, but let's talk about the U.S. It's only 12% of KFC's global sales, and it's been, well, a challenge for years. Any signs of life there?
There are. It's definitely been the weak link. But under the new president, Catherine Tan Gillespie, they're seeing, let's call them green shoots. Same-store sales were actually up 2% this quarter. It's not huge, but it's positive momentum.
So what are they doing differently?
Focusing on relevance again. They mentioned a social media campaign for spicy wings and wedges that apparently brought in new and lapsed customers. And that saucy chicken pilot seems to be doing well and expanding in the Southeast. So finding products that click better with today's U.S. consumers.
Okay, so KFC and Taco Bell. Strong growth, global power, driving almost all the profit.
Makes up 90% of the divisional operating profit between them.
Which brings us to the elephant in the room, the reason for this whole strategic review. Pizza Hut.
Yeah, the contrast is pretty stark, isn't it? While KFC and Taco Bell are booming, Pizza Hut is struggling. System sales were down 1%, core operating profit down 8%.
And the U.S. numbers were particularly bad.
Oof, yeah. U.S. same-store sales dropped 6%. Globally, down 1%. That's just not sustainable when the rest of the portfolio is flying.
So this directly led to the big announcement. They're exploring options, potentially selling the brand.
It feels like they're admitting defeat, almost. Or at least admitting that maybe they aren't the best owners for Pizza Hut right now. The official line is about maximizing value and helping Pizza Hut compete better in the, very crowded pizza market.
They suggested maybe a different owner, a different structure, could handle the long turnaround needed.
Right. It's a multi-year effort. And maybe Yum wants to focus its resources elsewhere, namely on KFC, Taco Bell, and their tech platform.
It's worth pointing out, though, Pizza Hut is still opening stores internationally. 289 gross new units in Q3. Often, they're still the biggest pizza developer globally.
True. But Those openings were wiped out by closures elsewhere. They mentioned specific franchise issues, like pulling back significantly in Turkey.
Well, while they might be strategically coming back on one brand, the thing tying everything together, the growth and the potential future structure, is the tech. Byte by Yum.
Absolutely. This is their secret weapon, their competitive advantage. The scale is incredible. You mentioned $10 billion in digital sales. That's huge, with a digital mix around 60%.
And it touches everything, right? Customer experience, store operations.
Exactly. Under easy experiences, you've got things like KFC's global digital mix hitting 63%. Their Byte commerce platform, the scalable website and app system, is rolling out to Pizza Hut in Canada, Kuwait, France, making ordering smoother everywhere.
But the easy operations side, the AI stuff, that seems really futuristic.
It's already here, though. Byte Coach, the AI tool giving recommendations to store managers, is in over 28,000 restaurants.
28,000?
Yeah, and they're making it smarter. Next year, it's supposed to give individualized guidance, like based on that specific store's operations data, customer feedback, audit results. The AI will give tailored advice to the manager.
So not just generic tips, but specific actions for that manager in that store.
Precisely. Think about the power of that personalized coaching rolled out instantly across tens of thousands of locations. That's massive scale efficiency.
And they're using AI internally, too.
By early 2026, they expect pretty much all their Byte software developers will be using AI tools to help them write code faster, better, safer. They're seeing significant productivity gains already. It's embedding AI deep into the company's engine room.
We should probably briefly mention Habit Burger and Grill, too, the smaller brand.
All right, the fast casual piece. System sales grew 3%, same-store sales up 1%. They opened 8 new spots. It's ticking along, but clearly the main story is KFC, Taco Bell, Pizza Hut, and the tech.
Okay, let's wrap this up. The big picture here is Yum, making a huge strategic pivot.
Definitely. They're doubling down hard on KFC and Taco Bell, the brands driving 90% of the profit. Everything seems geared towards accelerating their growth, powered by that unifying Byte technology platform.
And meanwhile, they're taking really bold, maybe necessary action on the underperformer, Pizza Hut, even if that means potentially selling a legacy brand.
But they're signaling confidence overall. They reiterated they're on track or even ahead of schedule for their growth targets for KFC and Taco Bell unit growth, sales growth, profit growth. They're still aiming for those big long-term goals: 5% unit growth, 7% system sales growth, and at least 8% core operating profit growth annually.
That confidence is palpable, but it does circle back to that really fascinating Taco Bell acquisition. Spending $670 million to buy stores feels like such a departure.
It is, and it sets up a really interesting question for you, the listener, to think about. Yum is focused on 2 things: leveraging their incredible scale and pushing cutting-edge AI through Byte.
Right.
So it is successfully integrating these 128 company-owned Taco Bell stores, this big, strategic, asset-heavy investment, shows a new way forward. Is this a necessary playbook for growth now, especially in really competitive, important markets?
Or is it just a one-off, a unique situation where they saw a chance to face a specific problem and unlock potential that franchisees maybe couldn't?
Exactly. How might this blend of owning some key assets while still leveraging the massive scale of the franchise system? How might that redefine their growth strategy over the next few years? It's a fundamental question about their model.
A huge question indeed, especially for a company built on being asset light. Lots to chew on there. Thanks for diving deep with us today.
Always interesting. Catch you next time.